Good day, investors. I'm Rachel McVeary, investing editor at U.S. News and World Report, and I'm talking to the financial advisor contributors to Advisors Corner for our second Investing Experts Roundtable today, highlighting the best low-risk, high-return investments for 2025. That's whether you're a retiree, nearing retirement, or just generally risk-averse or a little wary right now as the new presidential administration begins to make some changes, some controversial. So, which investments are most promising this year? Still, in terms of providing the most return with the lowest risk. So, weighing in on this topic are Kate Stalter, Series 65 licensed financial author and investing expert, Julie Pinkerton, chartered financial consultant and CEO of Evozen LLC and founder of Client First, and Margarita Chang, a certified financial planner, member of the board of directors for the CFP Board of Standards, and founder of Blue Ocean Global Wealth, and Scott Ward, a certified financial planner who joined Compound Planning this past year as a specialist in retirement transition strategies and portfolio management. So let's start right off with you, Kate, if we could. What low risk, high return investments should investors be looking into this year?
Yeah, thanks, Rachel. And I've written about this a few times actually in some of the investing articles recently. And I want to talk a little bit about the utility sector. And I know that's not the first one that everybody kind of jumps at and says, wow, that's super exciting. But maybe I'll convince a few people like this is why you should look at it. In the second half of 2024, it actually was outperforming the broader S&P at times. Now, the XLU, that's the S&P Utility Sector ETF, that has a dividend yield, let me see, I wrote that down here, 2.83%. And that's versus about 1.2% for the wider S&P. Now, utilities are not the highest yielding sector. That's actually energy and real estate. And like I said, they're not the kind of stocks people generally get excited about, but we're seeing that a little differently right now. The top S&P performers this month in early 2025 are Vistra, Constellation Energy, GE Vernova, which is utilities adjacent, and that one has a small dividend. And a lot of the reason for this goes to the usual suspect these days, right? AI, demand from data centers. Now, the sector has a few potential pros and cons. It's pretty capital intensive, relies on leverage. So if interest rates remain somewhat elevated, maybe higher than the market might have expected, just a few months ago, that could put a damper on some of these rallies. And on the plus side, we're probably entering into an era of less regulation, and it's common to see regulatory delays for rate hikes. But we might see fewer of those, at least from the federal government side. So that could help these stocks. And the biggest reason that, Rachel, that I was looking at utilities right now is not for price appreciation. Vistra has kind of been exciting in that way lately, but it's really just for reliable income. If the market turns lower this year, which is certainly possible because we've had 2 years in a row of strong performance, retirees should be looking at ways to generate income so they're not withdrawing stocks that are trading lower, right? And even for non-retirees, these income stocks can help mitigate some of the volatility of equities. Now, you get a lot of utility stocks that are dividend kings, achievers, aristocrats that have been paying dividends for decades in some cases. In addition to the XLU, you've also got Vanguard is an ETF. And I'm just putting these out there as ones that people might just take a look at and decide what's appropriate for them. Got a low expense ratio, index based. I'm not always a fan of actively managed vehicles because you get some extra costs. But there is one UTS. It's designed for a little more capital appreciation along with the yield. It's got a lower yield, a little higher expense ratio, but at 0.49%, not horrible. So, there are some ways that people can access this sector that is all of a sudden getting kind of interesting for income.
Okay, you said that fund was UTS, was the ticker?
UTES is,
UTES.
yes, is the
Oh,
ticker, right?
okay. Scott, what do you think? What are the low risk, high return investments we should be looking at now?
Well, Rachel, when it comes to diversified investments, I like to lead with yes. But today I'd like to focus a little bit on international equities and bonds in the context of opportunity costs. Morningstar's Amy Arnott recently wrote a fascinating piece on this. Let's say that someone began with a balanced allocation of roughly 60% in equities and roughly 40% in bonds 5 years ago. If that investor left her allocation intact for that time period, it's likely that she would now have an allocation that is well unbalanced. And here's what I mean. Because of growth, that allocation probably looks more like a 75-25 mix, rounded up equities to bonds. But if you take a deeper dive and you can find some additional disparity among both US equities and international equities, that really translates to about a 56 to 17% disparity, respectively. So here's my point. If it's been a while since you rebalanced your portfolio, now's a good time to consider one. And I'll give you three reasons. Number one, outperformance among US and international equities flips about every 8 years. We're now in year 13 for domestic outperformance. 84% of the world's economic activity and 65% of public companies with market caps above 5 billion are located internationally. Let's zoom out for just a moment and pull it all together in terms of opportunities for both equities and bonds. Prior to 2022, we were in a 1.5 to 2% return world for bonds. That's changed. Over the next 10 years, the return estimate for bonds, global bonds in particular, is about 5%. And in the same time period, over the next 10 years, the return estimate for US equities is around 6%, compared with about 8% for equities outside of the US.
So, and a lot of people are talking about emerging markets having potential this year. What do you think about that?
Yes.
All right, I like that
All,
answer.
yeah, all the above. Right, right.
Right.
The big issue here is that you just don't want to miss out. Yes, here in the U.S., the outlook is pretty positive for this year in terms of earnings expectations relative to other parts of the world. But that could potentially change in the next few years. And for investors who are looking at a time horizon of, say, 10 to 20 years, they definitely don't want to miss out on opportunities as they present themselves across the world.
Okay. Hi, Rita. What are the low risk, high return investments you'd recommend investors looking into?
Well, one of the things I wanted to talk about is I wanted to piggyback upon what Scott was saying about emerging markets. So I just returned from Asia, Southeast Asia, Indonesia to be exact. And Indonesia is now included in BRICS. So it's not just Brazil, Russia, India. There's another I, Indonesia, China, and South Africa. So there's a lot of growth in Southeast Asia, and people don't realize the important role that Indonesia plays in commodities and natural resources. So now we're going to be transitioning to less risk and dividend investing. If you're not sure like what stocks to pick, you can definitely start with the S&P 500. That's the index. And within the S&P 500, you can look at, I agree with what Kate was saying. Sometimes you can take advantage of diversification through passive management, and you can get that through ETFs, exchange traded funds. And some examples would be Vanguard Dividend Appreciation Fund, Dividend Appreciation ETF, VIG, Invesco KBW Premium Yield Equity. That's a REIT. And the benefit to having income from REITs and also dividend payers is investors can make money two ways. First, by capital appreciation. The shares you purchase go up. Next, they can make money by the dividend yield. Now, we just talked about capital appreciation. Let's just say the market is volatile and you are not experiencing any capital appreciation. In fact, there's capital depreciation because there's volatility. Investors can still enjoy the benefits of receiving the dividend income. And if you're reinvesting that dividend income, you do lower the volatility. So I think investing in dividends is a good way in which investors can benefit from additional income. And if they don't need the income, they can just reinvest the income.
Right. And using an ETF as a vehicle can reduce the risk even on, emerging markets or something else that's more high risk, as you said. And the dividends also help with that. Okay, so Julie, thoughts on this low risk, high return investments for 2025?
Absolutely. As you can tell, I'm surrounded by some very, very intelligent individuals who have this is their passion. And this is one of the reasons why I think that financial advisors are so important to any conversation to be able to manage risk for their clients. We do have a lot of do-it-yourselfers out there, though. And one of the good things is that to be able to look at investments that are in the news on a regular basis. And energy, for sure, is constantly in the news, especially with electric vehicles, solar farms, wind farms, the whole nine yards. And it's a very hot topic, but it is one also that investors, in order to be able to do well within it, need to be sure to keep an ear out to be able to pivot. And the reason I say that is that the market is constantly changing. Having just written about the top 10 most valuable car companies, we have seen that BYD, a Chinese automaker, has really been scrambling all of the car companies. And so a lot of them are retooling and rethinking a lot of the things that they're doing. But we also have manufacturers like Rivian, an American manufacturer who has done exceptionally well and has also produced a beautiful product. And so people see these cars all the time on the road. But even companies that have done well like that, they are doing well right now simply because Volkswagen has given them a lifeline with a $5 billion infusion. And the Biden administration just this month gave them $6.57 billion in order to be able to continue their production line. So it's very important for people to be able to take a look and be able to understand what is going on. And the news helps them to keep abreast of this. Something else, though, that is occurring is because China is moving in with all of these electric vehicles, is that tariffs have become a popular topic. And certainly with the new administration coming in, tariffs have been on the mind of a lot of people. But tariffs have been around a long time. Trump talked about them and implemented them against Chinese automakers in his first term. Biden quadrupled them during his term. And now, of course, that they are coming full circle again. So again, with one stroke of administrative federal action, it's very possible that investments can certainly change, and people need to be able to keep up with that. And then finally, of course, though, that tariffs often also raise the potential for changes in very conservative investments, such as CDs. And because of the fact that the Federal Reserve may have to step in to be able to offset what is occurring potentially in the area of inflation, it is possible that we're going to see these rates all over the board. They're still very attractive, and they can be an excellent way to diversify a portfolio to be able to take advantage of some of the investments that are a little bit higher round. Keep in mind that if interest rates go up for your CDs, they will also go up for your consumer loans and credit cards. And so to be able to manage your debt is another way to be able to keep your portfolio on track.
And just to add to that, we just did a story today on Schwab money market funds, and the rates are still up above 4% on a lot of those. So still attractive if you're looking for something conservative. So with so many potential questions I could ask, I'd like to focus this last part on some of what Julie said about energy and automakers. I mean, President Donald Trump has vowed to support oil and gas and has leaned away from renewable energy to this point, which the Biden administration had sought to boost through the Inflation Reduction Act, and Trump also moving away from EV subsidies. So I'd like to get y'all's comments on what does that mean, that renewable investments will be written off under a Trump White House, or will it make them more popular or somewhere in between?
I could actually speak to that because I just heard literally today that even though we may be hearing in the news exactly what you're saying, it turns out that Trump has pinned potentially an executive order for a new nuclear plant in Abilene, Texas. So it could be that energy is just simply changing, and we will still see quite an emphasis in that sector, but perhaps with different options coming into more favor than what we've seen currently.
Right. And nuclear energy certainly seems to be a hot area.
Yes.
And AI driving that with the data centers, as you mentioned already, Julie. So,
Rachel, I can jump into that too,
sure.
because I mentioned Vistra and some of these, exactly what Julie was saying there about some of the investment that is going into nuclear. And that is considered a form of clean energy, right? So it is, and that's where some of these energy stocks, we're seeing these big rallies right now. So it's actually happening kind of right before our eyes.
Right. And just getting back to the low risk point, jumping into an ETF again might be a better way to, using a thematic sort of ETF might be a safer way to do that rather than picking stocks. But we certainly have a pretty solid lineup of nuclear energy stock that have been doing well on an upward trajectory for a while now. So does anyone else want to add to the discussion about low risk, high return, and anything that hasn't been mentioned yet as far as a solid, maybe more traditional investment?
Well, Rachel, the only thing that I'd like to add is I know we've talked a little bit about policies, but predominantly, and we recently talked about this in a recent article. The biggest policy that I think institutional investors really have their eyes on this year, or really what's going to happen with the Fed. And so we've moved from an environment in which we expected. 3 to 5 cuts this year to maybe one or two. That doesn't mean it's zero, but I looked at the Fed Funds Watch this morning, and there's a 0.5% chance of a Fed rate cut next week. So you're saying there's a chance? No, I'm saying that we're probably going to get a little less than we want, maybe in terms of Fed cuts this year. But I think in general, for investors who are looking across their allocations and maybe see a little bit less of a weighting to fixed income, there's not a better time to buy into the bond market in terms of all the good things that bonds can do, in terms of safety, in terms of yield potential. That makes it appealing to a lot of people.
Rachel, I want to jump in too, because I was
Sure.
kind of looking at some fixed income as well. And one thing, this is kind of a cautionary note that I want to say here. Right now, high yield is well positioned, but people should think very, very carefully about going into that. Not saying there aren't situations where a high yield ETF could make sense, like HYG, for example. But the reason they're high yield is because they are what's called junk bonds. I had a client one time that said she didn't want junk bonds, and then we looked at her portfolio when she came in, she had like 3 different high yield
Oh, done.
ETFs. Yeah, she didn't realize those were the junk bonds. So just be cautious about that. I mean, shorter term, intermediate term bonds, that is, if you're going to continue, if we're talking about some with lower risk, that's always, just perennially the lower duration, lower term to maturity. Those are usually the ones that you will see a lower level of risk rather than some of the longer ones. And that's a little bit intuitive because who knows what's going to be happening in 20 years, with interest rates. It's easier to know what's going to be happening in the shorter term.
Oh. Anybody else? Well, if that's all, I want to thank you all for being here. And for the viewers, Please check out US News' related article on low-risk, high-return investments, specifically for retirees. Happy investing!